Computing Default Adjusted Bond Returns, copyright Lou Gaddis. In this topic, we're going to use transition matrices to compute multi-period default probabilities, understand the difference between a bond's YTM, yield to maturity, and default adjusted expected return, and compute default adjusted expected returns for a given transition matrix and recovery rate. Before we start, let's talk the difference between YTM and expected return of a bond. Remember from earlier topics, the yield to maturity of a bond is simply the IRR of the bond's investment, assuming the bond makes all contractual payments. Sometimes it's called the promised yield. So again, think of creating a vector in which you pay the market price of a bond. The bond does not default, and you receive all the coupon and par payments. In that case, the bond's return is just the rate of return from all the contractual payments. In some sense, it's the best case return, the worst case being it defaults right after you buy it. Now, a bond's expected return is not the YTM, at least for a bond that's risky. A expected return is the return which looks at the expected cash flows. It's the IRR of the expected cash flows. Now, the expected cash flows are the cash flows adjusted for the probability that the bond could default and the payment in default, which we call recovery rate. And it gets more difficult in that to compute the expected return of a bond, we need to look at every period whether the bond is defaulted. So if we're looking at, say, a 10-year bond, we need to know the probability that the bond defaults in year 1, 2, 3, 4, and so on. When we talk about bonds, we talk about their credit ratings. Credit ratings are issued by private agencies that try to assess the probability that the bonds will default or that the bonds will have a credit event. Credit event is what we call either a default of the bond or a ratings change. So a bond is upgraded from a single A to a double A or downgraded from a triple B to a double B. And also when we talk about bonds, we talk about the recovery rate. If a bond does default, you generally will get some payment. You're not left with no payments. You'll get some fraction of par after the bond or the company goes through bankruptcy. So typically you might receive, say, 50% of the value of par in bankruptcy. Here's a list of a couple S&P and Moody's ratings. So again, ratings agencies, what they do is assess the probability that a bond will default. So a AAA, both Moody's and S&P, are the strongest and have the lowest probability of default. And you can go down from AAA to AA to single A or using Moody's symbols. And you can see also there's a line drawn right here. All right, this line for Moody's and S&P is a fundamental difference in the bonds above the bond or above the line and below the line. The move from a AAA to a AA to a single A are little steps showing a little bit riskier. But when you go from, say, a triple B to a double B, that's a huge step. And it's actually a change in the category of the bond from what we call an investment grade bond to a speculative grade bond. Many financial firms have restrictions that their portfolios may only hold investment grade bonds. Now here's a transition matrix. These are used by corporate bond traders or analysts. And this one was generated based on Moody's historical data from 1920 to 1996. And this is in the Benninga textbook. And the way you read a transition matrix is you first look and see what term this is. This is a one-year transition matrix. So a transition matrix shows you the probability of transitioning from one rating to another over this amount of years, 1 year. So the way you read this is the rating at the beginning of the period. This is the rating at the end of the period. So if I have a AAA rated bond today, historically, there's a 92% chance that 1 year later that it'll still be a AAA rated bond. Historically, AAA rated bonds in a 1 year period have been 6% have been downgraded to a AA, 1% to a single A, and so on. But what you'll see is there's never been a AAA rated bond that was rated AAA that within 1 year defaulted. And that's not to say it was downgraded once a year for 5 years and defaulted, but this is just over 1 year. There's never been a AAA rated bond that defaulted in that year. And if I go to, say, a B rated bond, so if I buy a B rated bond today, historically, 85% of the time, it'll be a B rated bond next year. 6% of the time it's been upgraded to one notch, and a little less than 1% been upgraded twice. But however, there's never been a B-rated bond that was upgraded to a AAA within 1 year. However, these are downgrades. I'm sorry, these are upgrades. If you have a B-rated bond, 3.44% of the time, historically, they've been downgraded to a C, and 3.9% of B-rated bonds default within 1 year. So what we see here is this major diagonal here is really the probability that a bond retains its credit rating. Above this major diagonal are probabilities of downgrades from, say, AAA to single A, or B to C, or any rating to default. This area here are probabilities of upgrades. If you sum across a row, it'll equal 100%. So let's grab this data here. This is my transition matrix. Let's grab this data down to the yellow. And I'll go to Excel and I'll paste it in. Now let me move that up to the top. Alright, so here's my transition matrix. Again, this is a 1-year Moody's transition matrix, and if I was looking at a B-rated bond, I can see that the probability of default is 3.9%. But what if I was looking for the probability that this B-rated bond would default in 2 years? Well, that's a little more difficult problem than you might think. Because if I look at this, there are 8 ways for this bond to default in 2 years. Because the bond, which initially starts out at a rating of B, in the first period, it could go to any other rating. It can go from B to AAA to AA to single A to BAA to BA to B, remain a B, C, or default. So in theory, I'll just grab this. The bond could go from B to any possible rating in the first year, including going in default. But if I'm trying to figure out the probability of it defaulting in 2 years, there are only 8 possible paths for default, assuming it changes its rating once per period. And that is, it goes from B, let's look at scenario number 8, it defaults in the first year, and then just remains in default. Or it could maybe get downgraded the first year to a C, and the second year go into default. Or it could remain a B at the first year and then go into default. And then you got a lot of unlikely scenarios. These are all scenarios where the bond, which initially was a B, gets upgraded in the first year, then goes into default. And what you'll notice here, this possible scenario of default actually has no chance of happening based on historical data, because we never had a bond go from AAA to default in 1 year. Let's calculate the probabilities of the transition from this to this, the initial rating to rating 1, then the probability of going from this rating to into default. Now the probability of going from B to any other rating is actually given by this row here. So I can just go in here and say equals transpose. Oops, let me actually highlight this entire row. Equals transpose. And grab this row. Control Shift Enter. So these are my probabilities of going from B to any rating in the first period, which is simply this row. And then we'll calculate the probability of going from any of these ratings into default, which is actually this last column. So I'm just going to put a link up here to the first probability, and then I'll copy down. Alright, so these are the probabilities of going from B to every rating, and from every rating to default. If I take the joint probability here, take the product, this is the probability of going from B to AAA to default, which is 0. It's because 0% of the time is a B actually wound up as a AAA, and 0% of the time is a AAA actually gone into default. Well, let's look at the bottom of these more likely scenarios. The most likely scenario of default is defaulting in the first year. You go from B right into default and you remain in default. The second most likely scenario is get downgraded the first year, then move into default. That has a combined probability of 0.47. Actually, the second most likely event is actually this, number 6. You're a B, you remain a B, and then you go into default. And then again, these are the less likely scenarios of being upgraded and then downgraded into default. If I sum all these up, just take a sum. This is my probability of default in year 1 or 2. Now, if I calculate the probability of default in year 1 only, so let's just say probability of default in year 1 only, that's actually given up here in my transition matrix. Right? The probability of going from B to default is 3.9%. So the probability of defaulting in year 1 only is 3.9%, which means the probability of it going into default in year 2 would be 778 minus 39. So these are the three probabilities I care about. And actually, these two are actually the most important. If I have a B-rated bond that behaves like historical data, I have a 3.9% chance that it's going to default in year 1, and a 3.88% chance that it defaults in year 2, given that it survives year 1. Now, I could use this little matrix algebra to actually get this number here. Let me just show you. If I take an M mult of this row and this column, Control-Shift-Enter, I will also get my 778. Remember, when doing a matrix multiplication, you always take a row times a column. In other words, a 1 by n, one row by n columns, times n by 1. Inner dimensions n are the same. In this case, looks like 8. And the new matrix will have a 1 by 1. That's why I get a single cell there. So that's a shortcut of doing all this math to get this 778, is I could have just done an M mult of this row times this column. Now let's take our matrix again. Let's grab this matrix, and I'll put it in another sheet here. And what I want to do is actually take this matrix and square it. So let me copy it here too. But I want to delete the data on the second one. So here's my 1-year transition matrix. I can also calculate a 2-year transition matrix. And how I do that is I'd come in here and just put in an M mult. Whoops, let me try that again. Forgot to put an equal sign there. M mult. Take the transition matrix and have it multiply by itself. Control-Shift-Enter. There's my 778. All right, so that's a simple way of getting the 2-year probabilities of all of these ratings. So here's the 2-year probability of an A defaulting. You can see it's no longer 0, although very, very slim chance. And the 2-year probability of a C-rated bond defaulting within 2 years. It also makes you understand what an M mult is. An M mult, a matrix multiplication, each number in the new matrix is a sum product of the ith row of the first matrix times the jth column of the second matrix. That's why the 778 is this row times this column. Now I'm going to do something a little bit strange here. I'm going to take our initial matrix here, copy it. I'll put it in another worksheet again. So if I'm going to add a column and a row to it, let me just add this. And let me add this. Let me delete, and let me put 0 here. Let me put zeros everywhere else. Okay, so what I did is I added a row and a column, and I want to give this a new name. Let's call it defaulted and defaulted. And let me change a couple more numbers to make this 100% and 100%. So make sure you have these values in here because those are the ones you have to change. All right, so what have I done? I created an extra rating called defaulted. So if I start the year and my bond's already it's already in default, I'll just call it defaulted next year with 100% probability. If the bond's already defaulted, I'll continue to call it defaulted. Now this is a little matrix algebra trick, because if I take this 1-year transition matrix with that defaulted rating, delete that out, I was just doing that for formats. And now I do my matrix multiplication to square that matrix. Equals mmult matrix times matrix, close paren, Control Shift Enter. I now have this 2-year matrix. And the nice thing about this new matrix is if I look at B, here's the probabilities that I calculated last time. So in a 2-year transition matrix, a B-rated bond, there's a 3.9% chance it already had defaulted in year 2, and a 3.88% chance it defaults in year 2. Now this is important because when we try to calculate the expected return of a bond, I need to know the probability that the bonds default in each year, not the total default. So we'll always use a matrix that looks more like this, and then the one that didn't have that extra row and column. So now we're ready to calculate the expected return of a bond. Now the expected return of the bond is the IRR of expected cash flows. The expected cash flows are the probability of any state times the cash flow in that state. So I'm looking at a bond in any given year T. There are 3 possible states for that bond. It could default in that year. If it defaults in that year, we'll take the probability that it defaults in that year times the payment in default, which is by definition the par times the recovery rate. If the bond is solvent at that year, I will take the probability that it has remained solvent times the promised cash flow, which is coupon or coupon plus par, plus the probability that it's already defaulted or matured times the cash flow if it's already matured or has defaulted, which will be 0. So if I take the sum of the probability of default times payment default, it's probability that it survives times payment it survives, which is the promised cash flow, plus 0, meaning already defaulted. That'll give me my expected cash flow. So let's grab a little information right here about a particular bond. Let's look at a $100 bond face that's selling for $90. Let me just paste that here. So we have a $100 face bond selling for $90. Has a coupon of 10%, makes payments once per year, maturity is in 2 years, the rating is in B, and the recovery rate is 50%. I'm going to calculate the cash flows of the bond by year. So I'll say year 0, 1, 2. And now I'm going to calculate the promised cash flows and the yield to maturity, and then the expected cash flows and the default adjusted return. So the first thing we'll do is I'll calculate promised cash flows or contractual cash flows. So what if I pay $90 for the bond? I'm going to have an outlay of $90. And then in year one, if this is an annual payment, 10% bond, I'll get 10% of face, I'll get 10. And when it matures, I'll get that coupon payment plus par. So those are the contractual payments. If I then calculate the IRR of that bond, let me add some decimal places. All right, this is my YTM, which is the IRR of contractual or promised cash flows. But that is not the expected return of this bond. All right, let me add a little formatting to here. All right, the expected return of the bond, I'd have to take the IRR, so I'm still going to use the IRR of expected cash flows. Now to calculate expected cash flows, well, I can first put in this, pay the $90, that's easy. But to calculate the expected cash flows, I need the probability of default in year T. So this is my year T up here, 1 and 2. I'll need to know the cumulative probability of survival, and I need to know the cash flow in default. How much do I get paid if it defaults that year? Now the probability it defaults in year 1 is right up here in my transition matrix. The probability that a 2-year bond had already defaulted at the end of the 2 years is 3.9%. That means it defaulted in year 1. And the probability of the bond defaulting in year 2 would be given by the 388. Okay, so I have a 3.9% chance of defaulting in year 1, 3.88% chance of defaulting in year 2. The probability that the bond survives in each year, 96%. The probability that the bond survives both years, 1 minus 388 minus 390. So a 92% chance it survives both years. Now if the bond does default, I get recovery times face. And I can copy that. So now I'm ready to calculate the expected cash flow. In year 1, there's a 3.9% chance I default. If I default, I get face back and the bond is done. But there's also a 96% chance that I get my promised cash flow of $10 coupon payment. So my expected cash flow is $11.56. If I then copy that formula over, in year 2, there's a 3.88% chance it defaults in year 2 and I get 50, and a 92% cumulative probability that it's survived both year 1 and year 2, and I get my contractual cash flow of 110. Now we have an IRR of expected cash flows. This is the default adjusted return, which is the IRR of expected cash flows. Right, this is the number that's more important when thinking about buying, say, a corporate bond, because this is the number that adjusts for the fact that the bond is risky, could default, and get a lesser amount. All right, so let's do a little more. Let's take our formula that we just did, and let's add a little bit to it. Looks like I deleted that by mistake. We're going to use matrix algebra to solve this problem in a way that's going to allow me to change the rating, and it'll automatically update these cash flows. All right, but it takes a little bit of work, so let's go ahead and do that. Let's grab these ratings, A through AAA through default, and I'll paste them here as values, Alt HVV. And let me just create a vector called rating. And that vector is going to be this size. And let me just make it a formula in there. If this rating is equal to the actual rating of the bond, I'm going to anchor that. Then give me a value of 1, else give me a value of 0. So, since this is a B, if I copy that formula over, it's going to put a 1 here where it has B. So again, the formula, if this is equal to this, anchoring the bond's actual rating, make it a 1, else make it a 0. And we're going to use this vector in a minute. So let's calculate two other vectors. We'll call this one x1. x1 is going to be rating this vector times the 1 year transition matrix. I'll call it TM1. All right. So if I were to come in here, highlight this whole area, equals mmult. Take my rating vector. I'm actually going to anchor that now. Comma, my 1 year transition matrix, not the 2 year one, the 1 year one. And Control Shift Enter. So notice what happened here. These probabilities, well, let's first talk about what it is. So again, it's just an mmult of this vector here times this transition matrix. This vector is all zeros except for 1. And remember that when you multiply two matrices together, each number is a sum product. And by creating a vector of all zeros and 1 under B, this is a common method for manipulating matrices. When I multiply this times this, everything gets zeroed out. In my solution, it simply selects this row. So you can see 0, 0.04, 0.15. That's that row. Now the nice thing is if I were to change this bond to, say, a C-rated bond, it's going to pick up this row. So it's just a trick, because all I need to know really is this row for a given rating. So I'll change that back to B. And let me just I'll just copy this formula down. And let's make a vector called x2, which is ratings times this 2 year transition matrix. So let me highlight this. And let me just fix this. So it's ratings, mmult ratings times, and I think I need to fix this. Slide it down and grab the 2 year transition matrix. So now I have mmult rating times a 2 year transition matrix. Control Shift Enter. And it grabs for the B-rated bond this row here. 388, 399, 390, there you see that. So I created these two matrices, which really, if it's a B-rated bond, all I really need are this row and this row. And let me create a couple other matrices. Actually, let me grab these ratings again. Copy. Alt HVV. Let's create two vectors called payoff 1, payoff 2. This is following, again, the Benninga textbook way of solving this problem using his named ranges. So payoff 1 would be the cash flow at year 1 when if this bond has any of these ratings. So this is a 2 year bond. So if the bond winds up being a AAA at the end of the first year, I'm just going to get coupon times par. And then I'll just have a link here. As long as the bond doesn't default, I always get my coupon payment. Okay, so this is if the bond at the end of the year is rating above default, I get coupon. If it defaults, I get recovery times par. In default, I get $50 and the bond's over. If it's already defaulted, I get 0. Now, at the end of year 2, if the bond has any rating besides default, I get coupon plus par. Right, the bond's matured. I'll anchor that. So I can just copy that. As long as it doesn't default, I get my 110. If it does default in year 2, I get my 50. Otherwise, I get 0. So this is payoff 1 and payoff 2. The payoffs given the rating at end of year 1 and year 2. These are the probabilities of transitioning to any rating in year 1 and year 2. So now I can calculate my year 0, 1, 2 and get my expected cash flows. I'll put in minus the price again. Need to put a negative sign in there. Now I can solve this problem here, right? I already calculated these values up here, by the way. I'll just show that. So now I'm going to calculate it again, but I'm going to use matrix algebra. Equals mmult these probabilities of entering any rating times the payoff of any rating, Control-Shift-Enter. There's my 1156. See, the same. I'll copy that over here and got to shift things around. I need to make sure this grabs the second transition and that one gets payoff too. Control-Shift-Enter. And then if I just copy my IRR function here, I can calculate the expected return of the bond, and it gives me the same values above. However, the nice thing about this way of solving the problem, let me get rid of this not to confuse us now, is if we're really looking for the expected return of the bond, this formula is more general in that if it's a AAA rated bond, notice the 1 goes here, which means I pick up this row and this row, get my new default probabilities, and get the expected return. If it were, say, a C-rated bond, the 1 goes here. That picks up these 2 rows, this one here, this one here, and I get my default adjusted bond return if it's C-rated 2-year bond. Now the only bad thing about this spreadsheet is it only works for annual payment bonds and only works for 2-year bonds. Now what we're going to do is the next few minutes is extend that to get more than 2-year bond. It could be any period. But that takes a little bit of work. Let's grab this function here. Grab the option base 1. It's called matrix power from the Benninga textbook. I'll go to my developer tab, Visual Basic, insert a module, or you can hit Alt F11, insert module. So here this function, matrix power, has 2 parameters. Matrix, that's your 1-year transition matrix, and n, the number of years you want to multiply it. If n equals 1, in other words, your 1-year transition matrix, matrix power equals matrix. Else, matrix power gets multiplied n number of times. So if I were to just say take this 1-year transition matrix with my extra column and row, I'll paste it there and I'll paste it there. I'll delete off this data and calculate a n-year transition matrix, where I'll put my n here. Say I want a 2-year transition matrix. I'll make that n. I can now use matrix power function, user define, matrix power. I'll pull in my transition matrix and the N at 2, Control Shift Enter. Try that again. There's my 2-year probabilities, and these numbers should look a little familiar. For my 2-year bond, there's a 3.9% chance that at the end of year 2 it has already defaulted. In other words, this is the probability defaults in year 1. This is the probability defaults in year 2. Now the nice thing about this spreadsheet is if I make a 10-year transition matrix, this is the probability that the bond has defaulted in years 1 through 9. This is the probability that the bond has defaulted in year 10. If I make this a 30-year matrix and look at the B, this is the probability that the bond defaults in the 30th year. This is the probability it defaults in the 1 through 29th year. Also notice when you go to a 30-year bond, you can see the AAAs do have significant risk. A AAA, if you buy a AAA rated bond today, we say there's no probability it defaults in the first year. But when we take this to the 30th power, there's a 447 plus 37.37% chance, add those together, that defaults in years 1 through 30. Specifically, there's a 37 basis point chance it defaults in year 30, and 447 it defaults in years 1 through 29. And you can see a 30-year C-rated bond, 81.64 plus 38% chance it defaults in years 1 through 30. So this is a handy little function to multiply a matrix n times. Let me grab functions we've used before. This is a function to calculate the YTM of a bond, given its par, coupon rate, maturity, frequency, and market price. And this is BondVal to calculate the present value of a bond. I'll take those functions, go back to my VBA, and let me paste it below. It has to be below because you can't have it above option base 1. So now I have a function to calculate YTM and a function to calculate BondVal. And the only reason I need BondVal is because YTM actually uses BondVal. So now I can use a more general formula from the Benninga textbook. If I grab this formula, or I'm sorry, this spreadsheet here, copy that, get out of there, and let me just go to a new worksheet within this workbook that has all my functions in it. And let's take a look at this. First of all, there's a lot of name ranges in this spreadsheet from copying over. This is my 1-year transition matrix. I'm calling it TMAT. Here's my bond price. I'm calling that price. Coupon, recovery, MAT, rating, payoff 1, payoff 2. All right, so this is, and also these payoffs are assuming are just a percentage of par. So your coupons are 9% in this case. Actually, let's change this back to our original bond. It's a bond selling at 90, 10% coupon, 50% recovery, 2, and a B. So remember, your coupons were 10% of par. At maturity, you get 110% of par, and these are your recovery rates. Now, if you look at again, here's our payoff 1. This is payoff 2. This is my if statement that gives me my ratings. I'm calling that rating row. And see, there's B for my B-rated bond. This is minus the price. Now the trick is this formula here, which then gets copied. If you look at this formula, let's actually look at it in PowerPoint. So here's the formula in PowerPoint. Well, looks like it was there. Let me see. Let me shrink that down. Here it is. So the formula, what it says is if this number here, and let's take a look at, say, the 5-year one. The formula, because this formula just gets copied across. It would say if this 5 is greater than the maturity of this bond, the expected cash flow is 0. In other words, if it's matured, the cash flow is 0. Else, if this 5 is equal to this value, in other words, if it's a 5-year bond and this is year 5, then what the cash flow is, it's as an M mult. This row times this matrix to the nth power. Remember, to calculate cash flows in year 5, I need to know the probability of defaults in year 5, which means I have to take this matrix to the 5th power. So if it is maturing in its year 5, take this to make sure I get the right row, times this to the 5th power using matrix power, times the final payoffs. So this will calculate the probability of all of these ratings and multiply times this. And then the last part of the if statements, else, if it has not matured, do the same thing but use this column, payoff 1. So let's recap. If the bond has matured, in other words, this value here is greater than this value, put in a 0. If it's equal, take ratings row times this to the nth power times payoff 2. Else, takes this times this to the nth power times ratings 1 to pick up the coupon payments. Now back to our spreadsheet. I can take that formula once I have it entered once, and I can copy it for as many years as I want. Looks like I just went out to 57 years. You can go farther. Now the nice thing about this spreadsheet is now I could enter in, say, let's try a C-rated 5-year bond. Now the C will change the 1 to go there, so now it gets the right row in the transition matrix, and the 5 will make sure that the cash flows end at year 5. And you can see I have an expected return of 572 and a YTM of 1283 for this particular bond. And so that's the general model. Now a couple of caveats. This model is a great model from the textbook. Works for any maturity, any rating. What it doesn't do is less than one payment per year. Or I'm sorry, more than one payment per year. So if you wanted to get, say, semi-annual payments or quarterly bond payments, you'd have to adjust the transition matrix to get, say, a semi-annual transition matrix, a 6-month transition matrix, and then have the periods multiplied times the number of payments per year. So we're not going to deal with that. Now, using this model, you can see as long as you're dealing with 1-year annual payment bonds, it's just a matter of getting its current rating, maturity, price, coupon, recovery. Now, recovery is a tough thing. Right? Recovery is if the bond defaults, how much is recovered in bankruptcy as a percentage of par. Now, to give you some help, you might just say look up the industry. So here's a table from 1971 to 1995. Over that period, utilities had 56 defaults, and the recovery was 70%, which was the highest. So you'd expect utility companies maybe that would have the largest number of hard assets, power plants. Therefore, you have high recovery rates. One of the lowest ones are financial institutions. So if a bank or a financial institution fails, there were 66 failures over this period, The bond holders, if the face value were $100, they got $35 back in default. So I could first start by just putting in my industry. Then I could maybe adjust it. Here's some data saying that recovery rates, if there were, say, the average senior secured bond had these recovery rates for investment versus non-investment grade, versus senior unsecured, versus senior subordinate, versus subordinate, and so on. So what you'd want to do is look in your industry and then adjust the recovery rate by whether the bond, where the bond is as far as the priority order as far as getting paid. So if I had a subordinated financial, I might go here and look at this financial number, 35%, and maybe adjust downward for the fact that it's subordinated, or adjust upward if it's maybe senior secured. And we could also say look at recovery rates by over a period of time and see that recovery rates might be falling or rising. Just give you an idea that this is hard to forecast, and they do change quite a bit. So I looked in Yahoo Finance and I found this Sprint 8 3/4 2032 BA 22-year bond when I looked into this a few years ago. So we can plug this into the model. Bond selling for $96.70, $8.75 coupon, and it was a BA at 22 years remaining life. I'll just leave a recovery rate of 50%, $8.75 coupon, and it was selling for $96.70, 96.7% of par. So you can see what this model works as it gets the new rating. It gets cash flows out through 22 years. If I look out here, I'll see it cash flows are out through 22 years, and calculates an IRR of 812, expected return, and a YTM of 910. Again, this is the number that's most important, the 812. That's the expected return. So that's the model. It's default adjusted bond returns for calculating annual payment bonds of any maturity of any rating. So in this topic, we use transition matrices to compute multi-period default probabilities on a standard difference between a bond's YTM and default adjusted return, and compute a default adjusted expected bond returns. Now, as an analyst in a corporate bond fund, your job would then be to look at a particular bond, write down its stated information, and then how you can maybe beat the market or beat your index is maybe you have proprietary transition matrices that your firm develops. Or maybe you do some fundamental analysis and you have estimated that this BA bond is going to be downgraded based on maybe your estimates of coverage ratios to a B. So you might actually treat it as a B and maybe earn some extra money being ahead of the curve on anticipating a ratings change. Or you can maybe earn an extra little percent by becoming better at estimating recovery. You might look at the firm and say, well, compared to its industry average, I think this firm has more hard assets than average, so I'm going to increase the recovery rate. So looking at corporate bond portfolios, it's a matter of looking at its current rating, anticipating changes in ratings possibly, and looking at recovery rates.